Ladies and gentlemen, welcome to the third quarter Cadence Capital Limited webcast. The first slide here, you'll just see a summary of the fund. We now have approximately $250 million of funds under management, and actually are one of the top 5 most traded listed investment companies on the Australian Stock Exchange now. The fund traditionally has had about a 7% fully franked yield, which grossed up is about 10%. We have more than 60% of our shareholders are now self-managed super fund. In fact, it's actually nudging towards 70%, and we have 4,500 shareholders. If you would like to get more information on the fund, there are several brokers covering our stock now, and I would strongly encourage people to go to the website and have a look at some of those research reports. The following slide actually shows the performance of the strategy over 9 and something years now, and the fund has delivered between it oscillates to around 19 to 20% gross performance against an All Ords accumulation index that is around 6 to 7%, closer to 7% per annum now, which actually for a point in history is an amazingly low return. Over the last decade, equities in general in Australia have performed below the average of 10 to 12% return. We think over the next decade that these numbers should normalise, and equities should deliver about 10 to 12% return to justify the risk involved in investing in equities. The slide at the bottom shows our average exposure, which shows that on average in the last year or two we've been holding around 25 to 30% cash, which helps to give us a good risk-adjusted return. The next slide shows the dividend history for our fund and shows not only the interim and final dividends, but also the franking that shareholders receive when they receive those dividends. We have just paid out our 5-cent interim dividend, and that dividend had a dividend reinvestment program which many people participated in, and the dividend reinvestment program shortfall was recently placed with a number of existing shareholders and also a number of new shareholders via ASX book build. The next slide is actually an adaptation of something that appears in our newsletter, which shows our net tangible asset return on a gross basis compared to the All Ordinaries accumulation return, but also shows franking. And we find that that's a very important factor to highlight, because franking isn't actually shown in your NTA performance. It's not something that's reflected in the growth of your NTA or in the dividends paid out. And I think you can see from these slides that our franking paid out is on average 3 or more times what the All Ordinaries index franking is. Turning now to our portfolio, and I'm going to focus on the top 2 stocks in the portfolio because we have been asked a lot of questions about these stocks, and our top 2 positions are actually reasonably recent positions. I mean, they've all been there for over a year or 2, but many of the positions in our portfolio actually are there for 3, 4, 5 and 6 years. So these are relatively new positions. Henderson is a funds management business that is both listed in Australia and the United Kingdom, and is a spin-off from the AMP, and interestingly enough, in our words, has kind of fallen between the cracks, because Australians have viewed it as a United Kingdom stock and the UK market has viewed it as an Australian stock, and actually was trading at about 2/3 of the valuations of the fund managers here in Australia, so was actually fundamentally cheap. The other thing that Henderson's has really successfully done has moved away from commoditized products to absolute return funds, as well as acquiring 2 acquisitions just after the global financial crisis at really compelling prices. Now those factors combined have meant that the earnings growth for Henderson has been extremely strong over the last 3 to 4 years, as well as the trending price movements have been upwards, really strongly upwards, and that has been, from our point of view, met all of our criteria, both from a fundamental point of view and a technical point of view. We have invested in this position initially at around $2, then added to the position 1% at a time. A maximum exposure is 5% at cost, and the position has actually grown bigger than 5% because the position has performed so well. Henderson recently put out a PowerPoint presentation, which I'd really strongly encourage people to read. It's a very, very good PowerPoint presentation, and just shows the strategy that they've implemented and will continue to implement over the next 5 years. We remain very comfortable with the Henderson position. The next position, our second biggest position, is actually Macquarie Bank. And really Macquarie Bank falls into that category of stock which was loved before the global financial crisis and, for want of a better word, hated after the global financial crisis, and actually fell to around $16 from a high of nearly $100. Once it had fallen and reached a point of maximum pessimism, it started to recover, and we put our first 1% position in at $23, and we valued the cash in the bank and the traditional funds management business alone at that stage is worth $16. So we got the rest of the business for about $7. We've added to that position as it's gone up in value. And Macquarie has also recently put out a quarterly review and once again is showing terrific recovery, particularly in the human capital parts of its business. 2 of the 6 divisions that are exposed to the market and exposed to M&A activity, exposed to global recovery, and those signs are looking very, very good for a continued recovery. And of course, as the earnings per share growth is increasing, so the PE multiple is recovering. And so we see 2 sets of circumstances again, a company that's fundamentally compelling and one that is technically and psychologically moving in the right direction as well. The other thing that I forgot to mention about Henderson is that it's 92% of its earnings are from offshore, and in the case of Macquarie, 68% of its earnings are from offshore. So our 2 big positions have significant exposure to the turnaround in the global financial markets, not only the Australian financial markets, and that makes both of those stocks compelling as well. So just finishing on those 2 stocks then, and turning now to keeping up to date on your investment in Cadence Capital Limited. Please, we'd encourage everyone to look at our website. We're in the process of rebuilding our website, and over the next 3 to 4 weeks you should see a new website. We do contributions to the Morningstar publication, Eureka Report, and we will be doing a contribution to the ASX website in the next week or 2. And so all of these articles will appear on our new website and will also appear on Morningstar, Eureka and ASX's website. And we continue to put out a monthly newsletter as well. So we would encourage anyone that's not on the newsletter, please join the newsletter. It's free of charge, even if you're not a shareholder. And if you'd like to keep up to date on some of our new investments and on some of our recent articles that we've written, again, please come to the website at www.cadencecapital.com.au. And if you'd like to talk to us in person, please feel free to ring the office at any time. Ladies and gentlemen, thank you for your continued support in Cadence Capital Limited, and we look forward to you remaining shareholders with us for a long time. Thank you.